cycle with subscribers left is going to be mind-blowing to me. They basically asked voters, has Biden improved your life? 18% said yes. They asked, had Trump improved your life? 40% said yes. It's really hard to win an election when your opponent has got a 2-to-1 advantage in making people's lives better. And what I would argue is that voters are romanticizing 2019, low inflation, less geopolitical strife, and forgetting about 2020 when Trump was telling them to drink bleach during a pandemic, right? So the challenge for Biden is to get people to think about 2020 overall when you start to think about this. If we can turn to the next slide, the reason why we believe that this is happening is because the reason why if we look at the next slide, the reason why we believe this is happening is because of something called the misery index. The misery index is something that has not really been talked about since the 70s, but it's the combination of inflation plus unemployment.
Come on, Dexter.
When you add those two together, that equals the misery index. And what is amazing to us is that of the past 16 presidential election years, the misery index has predicted 15 of those winners. It has predicted every single winner since the 1980 presidential election. And so the formula here is really simple and elegant. If the misery index is higher come October year over year, the incumbent party loses. And if the misery index is lower year over year, the incumbent party wins. But we know exactly what that number needs to be. Inflation and unemployment cannot be higher than 7.3%. In April, when you added those two numbers up, it equaled 7.23%. So Biden has a 0.7% margin for error on this metric from now until November. And again, it's 50-50. It's right on the margin line, which is why the race is 50-50, why the betting markets are 50-50, and why Biden has not been able to make this race a choice. And what Biden's trying to do is use the debate to make it a choice, but he's going to be hampered if the economy does not cooperate overall. This is why I say they'll release oil out of Strategic Petroleum Reserve. They know this. If I know this, they know this, and they're monitoring it extremely closely on how they'd be able to do it. This was not in their forecast in January. In their forecast in January, inflation was going to continue to moderate down, that disinflation would help them. And yet inflation has turned out to be a little bit stickier than they had anticipated, and it's causing a headwind for them. And then finally,
what's the misery index if Dexter doesn't do what Mike tells him?
So
that's our member who's.
Oh yeah, no, I understand. I understand.
And when you talk about the Veep sweepstakes, are you completely discounting a Veep sweepstakes with President Biden?
I am. So when I talk about,
I don't want to get you off your thing.
No. It's a great question. I'm really boring on this topic, right? Because I can come up with really cool, fun, creative solutions. We can have 3 candidates fight at the Democratic convention and have the delegates nominate. And I wouldn't call that 0% probability. But if President Biden came to address the North Carolina pension system, he would come in here and he'd say, I'm the best president since FDR. I'm the only person who could beat Donald Trump. When Harry Truman got off the ticket in 52, Johnson in 68, it created divisions and the Democrats suffered large losses. The vice president's not ready to be president of the United States yet. And so I should be the candidate. If I'm not the candidate, it's very hard to replace the vice president with somebody else, because that creates division, right? Politics is about addition. It's not about subtraction. You want to basically be building to your coalition. And when you start replacing, it becomes problematic. Now, I just want you to know there's a poll out that came out yesterday that 58% of Democratic voters want to replace Biden on the poll. Want to replace Biden. So technically, you could set up a system where you're at the Democratic convention and the delegates rise up and say, we don't want Joe Biden. And you make it look like a grassroots revolt. It's possible. But then you've just recreated 1968 all over again. And you're doing that in Chicago with protesters outside. Those are not very good optics for the Democrats, right? The Democrat
more likely that he could get replaced than she.
Well, I'm just saying it, but
yeah,
you got health. You replace her. There are scenarios to do it. Justice Sotomayor steps down. and from the Supreme Court, and Vice President Harris is then given that slot sometime in July. There's probably levers to move. I'm not sure she would take it. I'm not sure that the Biden campaign wants to move in that direction, but there are ways to do that. If so, I would look at Governor Whitmer as an option, Michigan, Governor Shapiro from Pennsylvania as an option.
Can Trump win without winning North Carolina?
Well, I would say if Trump loses North Carolina, he's probably going to lose. I would say that Trump is probably going to win North Carolina. Let's turn to the next slide, right? That's a good segue.
What thinks about the current governor of North Carolina being on the...
I understand. I know exactly where you're going. But I just want to show you this chart because these are the swing states. And so I've been watching Trump since 2011. I've been really studying him since 2015. Trump's never been winning in anything. Trump is winning in 6 of these 7 swing states. And he is winning in Nevada. Where's Nevada up there? He's winning Nevada by 7.2 as of yesterday, right? So I don't believe the polls are bad. When you're winning by something by 7.2%, that's a big deal. That's a state that Trump lost. Nevada has the purest economic voter in the country. They don't care about anything else. They care about what they're paying at the grocery store. Then you have North Carolina next to that. So there's a little bit of a cushion in North Carolina for Trump that I think transcends some of the other states where it's much closer in Michigan, Wisconsin, and Pennsylvania. But I do want to show you this other chart here where what you're seeing is Biden has made some progress in some of these swing states. He's actually got a formidable operation running in those swing states. And outside Pennsylvania, he's made up ground. And what I would argue to you is, if you lose North Carolina, you just got to make it up somewhere else. The path for Trump is to win these states that are higher in red and win one of the smaller Michigan, Wisconsin, and Pennsylvania. So there's a path there. What Trump would argue to you is that he's he's close to winning in Minnesota and Virginia. There's reasons for that because of the third-party candidacy. And Biden is campaigning in New Hampshire. If that's the case, Trump's probably going to win North Carolina, regardless of what happens in the governor's race itself. And conversely to that, the Democrats in the Senate are doing pretty good, even in the states that Biden is losing in. I don't think the Democrats have a Democratic problem. I think they have a Biden-Harris problem, right?
I was saying the current governor of our state, not the governor's race.
I understand.
Being on the national ticket.
Absolutely. I don't think he'll be the guy on the national ticket. But yes, if you know something more than that, that's really interesting to me. But look, there's always going to be down ticket races, and I expect the governor's race to be closer here than the presidential race itself. And I do think that's going to be true in most of the states overall. If I was Biden and I was selecting a new vice president, I would select Josh Shapiro of Pennsylvania, based on what he's got, Governor Whitmer of Michigan, based on where his problems are right now. We can turn to the next slide. The reason why I'm going through this, if Biden wins Wisconsin, Michigan, and Pennsylvania, and Trump wins Arizona, Nevada, North Carolina, and Georgia, the race will be 269 electoral votes to 268 electoral votes. In 200 years, nobody has ever fallen below 270 in a presidential race. No race has ever fallen below that. If Trump wins the Nebraska congressional district, which we put a nice picture there of Warren Buffett, 93 years old, what a way to go out. He could probably select a new president. If Trump wins that race, that electoral vote, it would be 269. It would be the first time since 1824 that we would have an electoral college deadlock. And when that happens, the vote goes to the House of Representatives for president, and the vote goes to the Senate for vice president. The reason this is important is that it's one state, one vote. So even if the Republicans lose the House, they could still control 26 or 27 states. Many of the most vulnerable Republican members are in New York and California, so there's no change in which party controls that state in the House races. And so you can have a minority of House Republicans elect Donald Trump if this scenario comes out.
Let me just clarify. Maybe other people are interested in this. One vote per state as determined by what?
Well, they would do a secret ballot. Well, there's different ways to structure it.
I know, but when you say 26 or 27 states, what you talking about? Who has the majority in the
Congressional delegation, yeah. Yep.
In the congressional delegation of that state?
Yep. So let's just say
not the House, not the state House.
Not the state House. No. So this is federal. Absolutely.
I know that.
Yeah. So absolutely. So very clear, because there's going to be issues at the state and where the electoral college are.
We're 7-7 today.
7-7.
Today.
Correct. Right. It will be based on the next election.
Okay. All right.
Okay. And if it's 7-7, that makes it harder to get to the majority. It makes it harder to get to majority, which is really, really interesting to us.
It won't be 7-7. It just is today.
It is today.
All right, good.
So this is, but the president is selected by the House. The Senate selects the vice president. So technically, you can have a Trump presidency and a Kamala Harris vice presidency in this type of scenario, right? Which would be amazing. Like, cancel your Netflix subscription. The reality show is going to 1,600. But I'm only showing you this because this, to me, is the ultimate tail risk. This is a 10% probability today, in my opinion. It's usually close to zero. But as you get into these really close elections, these are the types of scenarios that can begin to show up based on how our new voting structure of early voting has been set up.
And what's the market risk associated with that?
So in 2000, we didn't know who the president was for 6 weeks. And I worked for a governor at that time, and I used to write that governor a memo every week. And man, I could just remember the economy just falling off a cliff for 6 weeks. The economy was slowing all through 2000. And as soon as that election hit, we fell off the cliff. And the Federal Reserve had to come in and do an emergency 50 basis point cut as soon as Bush was installed as president. And the market didn't even know. There was no scheduled meeting. My sense is that this Fed is a more activist Fed, and they'll probably try and step in and ease conditions if they see it falling off a cliff like that. So we've become a little bit more sensitive to it. That's on the economic front. But if you had a minority of House Republicans elect Trump as president based on an 1824 ruling, at the very least, there would be a lot of lawsuits. At the very worst, there will be riots in the street. And I think a reluctance to accept the election results overall. And so that's why I call it a tail risk event, because you'd be dealing with economic, financial, political, and social unrest all at the same time. That's why we just want to plan for it. We want to be ready for it. But I would assume that our election night operation, which is usually in Washington, will be in some sort of suburb outside of Washington to just hedge my employees' risks of some type of event one way or another moving forward.
So to be clear, in 26 or 27 states, you anticipate that President Trump's party will be in control of the congressional delegations of those states?
Correct. Even if they lose the House of Representatives. That's how we stress tested it. Okay. Because what we did was we took
That's something I was unaware of. So.
We took a 40, but they won't have the majority. Like you'll have a Speaker Jeffries in that scenario, but they'll have a majority. Now, there will be a push to say, no, this isn't the way the voting should happen. The voting should be based on however that state voted. That's how members should vote. There will be all sorts of interpretations of the way that they should do this. I'm just giving you kind of the main way that this was done, or the way that people are thinking about it right now. So it will be a real bloody fight. And so that vote won't happen until January 3rd. The election is November 6th. So you're going to go 60 days through that uncertainty of this event. I just want to show you some investment implications, which I think are really what this is about. I think investors are very focused on 6 core areas: trade and foreign policy, taxes and budget, regulation, and immigration. If we turn over to the next slide, our big theme for this election is that the election is a referendum on the speed of deglobalization. The world is deglobalizing. The pace of that deglobalization will be determined by who becomes president. That first chart is the amount of imports coming into the U.S. from China. When Trump began to put tariffs on China, it was 21% of U.S. imports. Today, that number is closer to 14%. You've seen a de-risking out of China for various reasons, tariffs, COVID, the leadership of China, but Trump will accelerate this by raising tariffs. That next chart are domestic companies, companies with the most domestic income, relative to companies with the most U.S. multinational income. We run them relative to each other. We loop Biden or Trump's odds on it. And basically the market is saying if Trump wins, domestic companies do well. If Biden wins, multinational companies do better because of the speed of that deglobalization that's happening. This is fascinating stuff to us. This is not normal stuff. And there are different factors for why this is happening. One, your supply chain's got to move. That leads to higher costs under a tariff regime. Two, you could be retaliated on if Trump puts those tariffs in place. So these are massive changes, unlike anything that we've ever seen before. If we look at the next slide. The coolest thing I can show you today is that you can take the India stock market, you can run it relative to the China stock market, and you can overlay Biden or Trump's odds on it. Literally, the India and China stock market are trading off polling and betting odds that are happening here in the United States. And the idea is very simple. You put tariffs on China, the supply chains have to migrate somewhere else. India is likely going to be the biggest beneficiary of that. You say, well, that's not true. Mexico is now our largest trading partner. Would Mexico be a beneficiary? That next chart in blue, light blue, and dark blue, that's the Mexican stock market relative to the S&P 500 and Biden's odds of winning. It's literally the same chart. And that's because we're going to have to renegotiate the USMCA, which is NAFTA Part 2, in 2026. And the market believes that Trump will give Mexico a lot harder time. We have like 15 companies that we mapped out that have the most exposure to this. And literally it just moves with Biden's odds of winning. So this is China, India, Mexico. They are really at the heart of this whole deglobalization that's happening.
Give us a couple of examples of those 15 companies.
The railroads that go in there, the merged Kansas City Southern. In our report today, Jeff, you get the reports, right? In our report today, we have all 15 of those companies listed out. But it's auto manufacturing, rails, distribution that go back and forth. If we look at the next chart. This is European autos and Biden's odds of winning. I just got back from Europe. I've been there twice already this year. The fear in Europe over Trump is out of this world. It's like nothing I've ever seen before. Ukraine, auto tariffs, all sorts of concerns that they have, pressure on defense spending. I think it's overblown, to be honest with you. But it's something that they're very, very, very thinking about, right? So you start to see foreign policy begin to bake into this. The Middle East countries, they just float with Trump. It's very likely that no matter who wins this election, you will see a normalization of Israel and Saudi Arabia after the election. Biden is trying to have it happen before the election. It will remake the entire Middle East. The market just thinks that you get a better deal for those Middle Eastern countries under Trump rather than Biden itself. This is not something that I ever thought I would be able to put up these types of charts like this overall. If we look at the next chart. The other big issues are taxes. I think 2025 could be the largest year for tax policy since the creation of the income tax in 1913. I do not say that lightly, but we have $4 trillion of expiring tax provisions at the end of 2025. We are likely going to have to raise the debt ceiling in 2025. Our models right now suggest that it will have to be raised somewhere between July and December. So you have a lot of different fiscal catalysts that are out there. This is the first time that you have an interest cost that exceeds 14% of tax revenue in 30 years. Usually that's the inflection point for where austerity kicks in. So you have all the individual tax cuts of the Trump tax cuts expiring, child tax credit, standard deduction, income tax rates, the estate tax rate. The AMT comes back. You have the global minimum tax coming back. You have all these Inflation Reduction Act tax credits. This is going to be like the Super Bowl of taxes, and it's going to hang over the market all of next year. Biden wants to raise taxes on the wealthy and corporations to fund middle-class tax cuts. Trump wants to just extend all of his tax cuts. The bond market's probably not going to let him do it. And so Trump's going to have to find out where there's austerity to offset it. He's likely going to try and find that through trade rather than through tax policy. Very interestingly, I'll give you some Mar-a-Lago patio talk here. Trump is basically asking anybody who goes down to Mar-a-Lago to figure out how to close the deficit without putting the economy in a recession. So there's a different level of focus on the deficit from Trump that we haven't seen in 40 years from his personality, right? Like, it's never been about austerity. The market is treating Trump as going to be worse for the deficit than Biden is, and yet the way Trump is thinking about it privately, I think, is a little bit different than the market has been thinking about this. But what you'll see from Biden is a broad argument that Trump is going to politicize the Fed, he's going to blow out deficits, he's going to shut off the border and cut off the supply of labor, and he's going to increase widespread tariffs, and that's going to increase inflation. And I think that's going to be a big theme in the debate as we get there. Tax policy will be central to all that. If we look at the next chart.
So of the $4 trillion that's coming up on a cliff, what's the biggest one? The state tax?
I would say the individual income tax rates are probably going to be the biggest number. The child tax credit, the estate tax. By the way, under any scenario, we think the estate tax exemption is largely going to be preserved. Right now, it's about a $13.5 million exemption. We think that that's probably going to
be or a couple.
It's 13 a couple. Yeah. So Senator Kyle in 2010 made a deal with Obama to couple that together. It goes to 6.5 for a couple on January 1st, 2026. I think even under the worst case scenario, it goes to 10 million. So I don't think we're going back down to 6. But in most cases, it's going to be preserved around 13 million.
This is Greg Patterson. I make a quick comment, and I apologize. Please. This is a rare thing that I'll be able to do, and that's correct an esteemed speaker. The estate tax exemption is per individual. Yes, that's the world that my firm works in. Thank you.
Thank you. I'm staying corrected. It's 13 individual, 26 a couple.
And I made Anarella feel better.
You're off the hook. Yeah, but and I apologize for that error. So this is a chart trader I brought for you. This is the 12-month rolling defense spending and the 12-month rolling interest cost of the U.S. government. What you'll see in the next 2 months is that our net interest costs will exceed our defense expenditures. This is a major event. People ask me when deficits matter. They ask me when debt matters. In our analysis, it never matters. When the interest cost goes high, that's when it matters. The budget chairman, who's a Republican from Texas, he's trying to figure out how to do the fiscal year 25 budget right now. The interest cost is squeezing out the priorities that they want to do for other factors. And historically, this is where you start to see austerity kick in. Not exactly where you want to be positioned when you have America's enemies coming after us. And I would argue that when you get inflation, you get higher interest rates. When you get higher interest rates, you get higher inflation. When you get higher inflation, you get more austerity, and our opponents try and come after us and say, can you defend all your commitments around the globe when you have that? And that's basically what's playing out across the globe right now in Ukraine, in the Middle East, and in Asia overall. Next chart, please.
I just want to add, because I'm a few people in the room, but it's stunning that when you look at Social Security as a part of this,
yes,
that these Social Security cost of living adjustments that have been baked in,
yep,
almost 18% over the last 2 years.
Yep. That's
and
right.
Another one this year.
Yep. 5.
I don't draw Social Security as I'm sitting here. But those increases are being baked into my benefit because I was 62 years old by December of 2022. So you think about how out of control this system is, that I'm getting a baked in cost of living adjustment and I'm not even drawing Social Security.
Wow.
And you multiply that times hundreds of millions and billions of dollars.
Yep, absolutely.
It's just one of those little things that nobody knows about that's making all this worse.
This is it. And right, so the best way I can explain it is, in the past 12 months, the U.S. economy has gone from 2.5 to a 3.5% growth rate. That's really impressive. It's a full 1% 100 pip change in economic growth. We've created $11 trillion of shareholder wealth in the stock market, which are taxable gains. And the unemployment rate is below 4%. In that environment, you should be printing money at the federal government that is bringing your deficit down. The deficit has gone from 2.1 trillion to 1.95 trillion during that time. Just to give you context, we are not getting any type of deficit reduction despite higher levels of growth because you have a Social Security budget going up 10%. You have a defense budget growing like this. You have your net interest costs. The spending is offsetting all the gains from higher levels of economic growth. If you get a recession here, it really is going to drive down tax revenues. And you're still going to have that spending baked in. So that's why for the first time in my 30 years, this is a really important point for the budget that I'm worried about. When we had high deficits previously, we had a very low interest cost, so it was all manageable. And now it's no longer manageable because all that accrued debt from previous years is now accruing pretty quickly at that higher interest rate. And a lot of this deficit is being financed on the short end of the curve through T-bills to preserve liquidity for this year. So it's a real challenge. And I look at this, and when I say I'm more worried about 25 than I am about 24, I got to deal with all this. $4 trillion of expiring tax provisions, which, if they expire, will put us into recession, yet balancing the needs of our fiscal situation because we got to start getting our deficit under control. Geopolitical problems. These are real challenges for the next president. And this is no laughing matter.
And it's a threat to states like ours.
Yes.
Because our budget is not $30 billion a year. It's about $47 billion a year with the pass-throughs to the federal government. So this is not just federally, but when they turn that spigot down in Washington, it's going to affect every program in North Carolina.
It's coming. May not be next year, but it's coming. It's slow. So just 2 more slides, then I'll get out of your way. Immigration, energy will be a very big deal. If Biden wins in this environment, with immigration being the #1 issue, I would expect continued moves at the border. The Fed is extremely worried that if the border shuts down, there's not going to be enough labor supply to take up the excess capacity in the system. But I can tell you, if Donald Trump wins, the border will be shut down before he even gets home from his inauguration parade. He'll still be at the Capitol by the time they shut down the border. And so what that does is it starts to impact the labor supply, and the Fed is very focused on this. I do not anticipate that Biden will continue to pump oil if he wins in the next term. I feel as if many of the energy policies being put forward here in the final few months, tariffs on renewable energy, more fossil fuel production, are just designed to keep the system floating until the election, and then that spigot will close off somewhat. So Trump wins, spigot goes right back on. Last slide. Very interesting to us. There's a very binary trade of companies that do traditional government services, Medicare Advantage, tax preparation, technology. Really a big component of who wins the next election will be about regulation. And the area that's going to require regulatory structure is AI after the 2024 election. What's very interesting to us is that the market is treating Trump very differently on growth stocks. Usually growth stocks go with Biden. They just feel that Trump is probably going to be a bit more deregulatory towards AI than Biden will be. And so the AI stocks have been moving with Trump's probability of winning, which is very, very different. Banks are probably going to have the most outsized sector impact of this election overall because of the nature of the banking regulations that are in the pipelines right now that are not going to be finalized before Trump or Biden head off into the election. So it creates a very, very big capital buffer. Jeff, I know you're probably looking at kind of what those capital buffers are, what that does for supply and demand of treasuries. This stuff, again, when I talk about it, it's really important for financial markets, probably the most integrated and intricated election that we've seen for financial markets at an individual stock level or individual company level, sub-industry, sector, macro and global all at the same time overall. Final chart. Equities aren't partisan. I could probably do the same thing for fixed income. We may have disruptions along the way, but the stock market figures out how to get around all that. The market loves divided government. They really love the current combination we got right now. The average return under the current configuration is about 16% annually. What we really don't like, or least favorite option, is a Republican president with Democratic Congress. We had that during the financial crisis and during COVID. So that's probably produced the lowest level return. Maybe it's a coincidence, but the last two major drawdowns, which we heard you just talking about before, both happened in that type of environment. But generally, the equity market's figured out how to make real returns, not just nominal returns, under any of these different configurations. And my sense is the political system will work itself out overall. It's more about finding where those earnings benefits are going to be the greatest, and this election presents that greatest opportunity. Thank you for having me today.
And what you just said also sticks to Republican House and Senate and Democrat president, right?
Correct. Yeah. So if you look at this, if you have a Republican Congress and a Democratic president, that average return is 13% annual. It's pretty good, right? I'll take that in a minute, right? If you have a Republican Senate, Democratic House with a Republican president, which is very possible, that return is 13.7%.
So what are the numbers look like as far as the House and the Senate?
Yep, awesome question. There are 18 Republican held seats that Joe Biden won in 2020. The presumption is in the House. The presumption is if Joe Biden wins the election, all he needs to win is 5 of those seats net, and he's probably going to have control of the House of Representatives. What you're seeing is that Trump is doing better in states like New York. RFK is doing okay in California. If that's the case and Biden's margins are much smaller in those very Democratic states, it could impact those congressional races. And if it impacts those congressional races, it may not be as clear cut that the Democrats win the House. So if Trump wins the election, it's going to be really tight one way or another. But it's going to be really hard to govern no matter what that situation is.
And the Senate?
The Senate is really interesting to us. There are the complete opposite in the Senate than the House. You have 3 Democrats in states Trump won in 2020. What we've been seeing over the last 2 or 3 cycles is
Tester, Manchin.
Yep, Tester in Montana, Manchin in West Virginia, Brown in Ohio. What we've been seeing is in the last 3 cycles is 100% correlation. States that vote for Trump vote for a Republican senator. States that vote for Biden vote for a Democratic senator. It's amazing how it hadn't happened in 100 years. Now it's happening in the last couple of cycles. So the consensus is like, oh, Trump's going to win Montana. He's going to win Ohio. He's going to win West Virginia. And the Senate's going to go Republican. I'd be very careful with that. What we're seeing is voters saying, I'm unhappy with Joe Biden's inflation, and I will hold my nose and vote for Donald Trump. They may actually vote for a Democratic senator and a Republican president, right? There may be like, let's put guardrails on Trump this cycle. Tester is an amazing candidate. I mean, a really good candidate. Really hard to beat. So Trump's got to run the tables in Montana to win those seats. Sure. There are other states I'd look at. Maryland has a moderate Republican former governor running. Michigan.
He'll win that.
He'll win it, right? So there's a lot more opportunities for the Republicans than there are for the Democrats. We anticipate the Texas race is going to close. Right now it's about an 8-point race. My sense is Cruz will win that race by 3 or 4. You'll see the Democrats make a pitch to try and go after Rick Scott. I think they'll be unsuccessful. But, you'll start to see some of the states not on the radar start to become on the radar in the second half of the year. But
Rick Scott's running for majority leader.
Yeah.
All right.
He's got to win the Senate first. He's got to win your Senate seat first. There's an abortion referendum on that ballot. He's called for making changes to Social Security, which Democrats are hoping that they can use against him with the senior vote. So, there's just different dynamics in play. Whether they put real money in there remains to be seen. But that's the thing you have to remember. The Democrats have a lot more money than the Republicans this cycle. And that's going to help them on some of those Gallup ballots stay a little bit more competitive in those Senate races.
And what about people not voting for president? Is there anything in your statistics about that?
But they vote for a senator, and they don't vote for president? Or, look, last cycle we had 160 million people vote. It's the highest voter turnout that we had since 1900. My assumption is that fewer people are going to vote this year. We were locked in our
How
home.
about people not voting, just skipping the top?
Yep. I think you'll see people vote less this time around, and you'll see people who do go to the polls just say, I can't vote for either one of them or vote for third parties. What that does is it benefits Trump. And the reason why it benefits Trump is because Biden was able to coalesce the entire anti-Trump vote in 2020. The anti-Trump vote spreads itself out, drives down Biden's numbers. VP for Republican, I would look at Marco Rubio, Tim Scott. I'm less on the J.D. Vance, Governor Youngkin, Governor Burgum. I think those are probably the four that are really in play right now. Trump probably sees Rubio as getting him some sort of benefit with Latinos, and that may mitigate his need to get more swing voters there. He's on the Intelligence Committee, he's somewhat vetted. I think you got to go with a governor. Governors are semi-vetted. It's not going to be Nikki Haley, but who am I? I'm just a small spoke in the wheel. Sorry.
Thank you for coming. It's always fascinating as a former elected official. I always enjoy your take on things.
Yes.
I too am most worried about 25, regardless of who the elected officials are.
Yep.
At some point, you have to deal with these issues. You can't just keep pushing them down the road. And from the most fiscally responsible town in all of North Carolina, I wish our federal government could have been a little bit like that over the last year.
What town is that?
Huntersville.
Yeah, Huntersville. It's good to know.
Issued 20-year bonds at 1.68, right?
Yep. Lowest in history
My
of
memory good?
North Carolina.
Issued 20-year bonds at 1.68%.
Blended average.
Wow. And what year did you do that? Did you do that during the
We
pandemic?
did it right before, it was February 20.
Wow. Wow.
Got it right before the market closed.
That's
Market
amazing.
closed about 3 weeks later.
So I think there's been a big push to do more long-term debt at the Treasury.
Thank y'all.
So in 2013, we had pretty extensive conversations with Treasury about, long-term. And they were like, look, our customers don't want it. I got the sense that Treasury didn't want to pay the extra interest cost for doing that longer-term debt because they're trying to balance the needs of what's in their existing budget with the long-term interest of the taxpayer. Trump came in and said he was going to do it, and Mnuchin talked him out of it. So there's something that happens in that Treasury building about doing something like that. And now what are we doing? We're basically issuing all of our short-term debt, our T-bill debt, at a 5% plus rate when we could have had that long-term debt at 2-3%. I mean, it's criminal, the mistake that the federal government made on Treasury issuance. And it's really what's compounding and accelerating the fiscal problems.
Politicizing the Fed, you touched on it earlier, one of the bigger concerns. So, talking about Trump doing that, what ability is there to do that, and how would it take to basically have to route the Fed actions through the White House?
Jeff, I woke up 5 weeks ago on a Friday. I'm spent every day on the road, so usually by Fridays I'm pretty tired. And the lead Wall Street Journal reporter is the Fed reporter, Nick Timiraos, an article that went up at 5:30 that Trump was going to politicize the Fed. So I'm just a little grouchy, because, I'm tired. And I looked at it, I read the article, and I said, this is a turtle on a fence. A turtle on a fence, a turtle just cannot put itself on the fence. Somebody has to put the turtle on the fence. There's a lot of people in Washington right now that go around and think that they work for Trump, even though they work at a think tank, and they have this idea, and somebody creative at the White House saw that idea, connected the dots, the reporter calls that think tank, oh yeah, Trump's going to do that. I gotta tell you, this is not in the cards of anything of the Trump thinking, okay? Trump is going to either select Kevin Warsh, Kevin Hassett, or Governor Waller to be Fed chair, and they're not going to be Arthur Burns. Right? Now, is Trump frustrated because Trump thinks he was right on interest rates in 2018? Absolutely. And the Fed proved to be too tight in the fourth quarter of 2018. So there definitely is that level of frustration, and I don't believe that Powell is going to be Fed chairman in March of 2026 when his term expires. Why is this happening? It's something that I've talked to the treasurer about previously, and that is that candidates, or we talked about it here, candidates like to go after your opponent's strength, not their weaknesses. Trump's greatest strength right now is that he had low inflation before COVID happened. So Biden has to figure out a way to make Trump the higher inflation candidate. And so on Friday, the White House Council on Economic Advisors put up a report that said the cost of politicizing the Fed. You could feel it every single day coming at us. Right? And I'm trying to warn my client, and they're like, it's not going to work. If you say something over and over again from the bullhorn to the President of the United States, it starts to have an effect. At the very least, it gives the Democrats who are demoralized by their own inflation something to talk about. The border deal in the Senate that the Republicans in the House rejected gave the Democratic voters, well, we wanted border security, but the Republicans rejected it. Right? They're basically giving their team the argument that Trump is going to be the higher inflation candidate. This stuff matters. So even though that article was there and it was a turtle on the fence, it's still important because I would anticipate that there's going to be an economic consulting firm, I have ideas of which one it's going to be, that will likely put out a report before the debate that if Trump wins, inflation will be 2% higher. I'm just giving you a random number, 2% higher than if Biden wins because of these four factors: tariffs, immigration, politicizing the Fed, and large deficits for the wealth. Tax cuts for the wealthy. And then Biden will use that in the debate. That's what I think we're setting up here. But my sense is that, like, I can put the chart up. I didn't bring it with me. The Fed has done about $1.6 trillion of balance sheet contraction since 2022. That was designed to get inflation under control and help with the interest rate increases. The Treasury Department, U.S. Treasury Department, has provided $1.55 trillion of net liquidity through the Treasury General Account and reverse repos at the same time the quantitative tightening's happened. So the punchline from that is that QT has never happened. It's why inflation is sticky right now. And so, like, they all guilty. And Trump is going to do the same thing if he wins. Trust me when I tell you, they're really interested in those reports, like how these tools work, right? And my point is that there's an incentive for the executive branch not to let the Fed tighten as much as they want. And I'm not snarky, but if I was snarky, I would put in my note, shot, chaser, shot, politicizing the Fed by the White House, and then chaser would be the chart showing that Janet Yellen just offset all of Jay Powell's QT. They may not have said nasty things about Jay Powell on Twitter or, tried to create executive decisions, but they offset all of his tightening. And I think that's important, what happens in practice overall. It's important for our outlook.
The question I had was on the debate topic. So we moved to a primary season in our own state and also obviously the federal level where there's just this avoidance, right? If you're leading, avoid it. If he comes out favorable in the trial results here, is there a scenario where tries to walk away from the debate here, the presidential debate?
Yes. I'm going to walk you through that 1 second. Every president that I've seen in my lifetime who goes into a debate, they're the sitting president of the United States. That first debate, they lose. Okay? Think about Mitt Romney and President Obama. President Obama was an amazing debater. Romney wiped him off the floor. I was in like a Delta lounge in the Atlanta airport, and people were like going nuts. It was like a sporting event in that place. Ronald Reagan, Bill Clinton. These are some of the greatest debaters because for 3.5 years nobody's ever talked to them like that, and they don't know how to deal with the confrontational nature. So in my experience, I always believed that a president's going to lose his first debate. And I thought it was a brilliant move by Biden to move that debate to June, away from September, where you can avoid that risk, because he remembers it. Okay. He's very sensitive about debates, Joe Biden, as well. What Biden's trying to do is move to big events where he thinks he has an advantage. He is going to lose on the day-to-day fight. They just sent Robert De Niro to do a press conference yesterday because they're being cannibalized by the news coverage and they can't make the election a choice. So they're like, we want to get away from that trench warfare and we want to get into big events. We want a debate. We want a convention. These are the types of events that we want. And so they think, well, we'll just challenge Mr. Bravado and we'll get him to agree to the terms. And the terms are amazing that Biden got. They will be sitting down like this. Okay, to me, that to me is the most critical thing, because it's really hard to stand up for 2 hours. I'm 48. At 81, forget about it, right? Like, I just think about my knees, okay? So they'll be sitting down. There's no audience. There's no walkout, okay? These are really important dynamics, okay? And then Dana Bash is going to be the moderator. And I would just watch Dana Bash's show on Sunday. Tim Scott came on, possible vice presidential candidate. Will you accept the election results? Are you a denier? January 6th, is Trump a criminal? Then Governor Walz came on, Minnesota, a state that's very competitive, Democrat. So is abortion going to be a big issue? What's the Biden strategy? Like, there's just an inherent bias in the questions, right? And again, I'm not like a biased guy. You never see me write about any of that stuff. But my point is that the issue matrix of the debate terms are going to be very skewed to Biden's favor and very hard for Trump to get on offense when that happens. And Trump's not good at debates. And so I look at all that and I'm like, why would they agree to something like this? You're in the lead. Why would you agree to something like this? If he avoids a conviction here, I think he might walk away. If he gets convicted, I think he's going to show up. By the way, it works the other way around. Biden felt that he needed to do the debate to make the election a choice. If Trump gets convicted and Trump's numbers start going down, Biden may say, why am I going to debate a convicted felon? I was going to debate him, but now I have no reason to debate him because he's just not normal. Like, he should not be president of the United States. And every day you're going to hear convicted felon Donald Trump out of Joe Biden's mouth. So it could work in both directions. And I just want you to know, like, if you believe that your opponent is going to destroy the world, then you're willing to do things that you normally would not do, like get rid of the presidential debate commissions or do student loan forgiveness or just not have a debate. Because our assumption for the first 3 months of the year is that Biden will not debate Donald Trump. As soon as we started seeing Biden go into a deficit in the race, we were like, oh, he's going to have to debate him. We didn't think June 27th. But, like, right, so the dynamics changed. And that's why Biden's doing it. If the dynamics go back the other way, he may not feel the need to do that.
Other questions on the floor, and then we'll go to Matt. Anybody? Go ahead, Matt.
If he does get convicted, what can happen? How quickly would he be forced to go to jail? If he goes to jail at all, will that change the entire dynamic? Because you can't debate if you're in jail.
Well, I think the Secret Service will have to cuff him right there in the courtroom, right? So that's the first thing you're going to say. I do think that he would have to go to jail almost immediately. There is discretion from the judge on how that proceeds. After what I saw yesterday, and by the way, I haven't been in the courtroom, but after the motions that I saw getting rejected, I believe that Trump will probably not get much leeway from this judge, and he will end up there for 48 hours. This will be appealed. The gymnastics it takes to get a conviction, he's on a misdemeanor. But the misdemeanor case only works if there's another charge, and then the two have to be combined. And then it could be on tax, it could be on all these different issues, and 4 jurors can say tax, and 4 jurors can say state contribution limits. No appeal court is going to relent, right? So it may turn out that he winds up winning an appeal, gets released, and wins on appeal later this year. But he will always be convicted felon Donald Trump. And that's what's important.
So if he goes for appeal, he can be released immediately?
I think he will be released. I think there's a leniency that he will be released. Do you think he's a flight risk? I don't think he's a flight risk. He's a lot of things. I don't think a flight risk is one of them.
But 2 minutes ago, you used the word misdemeanor, then you used felony.
No, he's on a misdemeanor charge. And what they had, like it's, what they're doing is.
He's what?
He's on a misdemeanor charge, but that misdemeanor charge is past the statute of limitations. So they had to pair it with a felony charge. And you need both of them to stick for this case to work.
By the jury.
By jury, yeah. It's the legal gymnastics that it took to get the word convict is pretty significant. And that's why the appeals process will be very, very difficult for the government to win, the prosecution to win on.
I know we're taking a lot of time, but these are important issues.
These are really important. Like,
And forgive me for saying this because I'm not the lawyer in the room, and I'm not defending anybody or any person or their character. But is it illegal to pay somebody hush money?
No, it's not. So the question is whether he skirted state contribution laws,
okay.
whether he had a conspiracy for the election, that if this came out, would he have lost the election? I mean, those are very difficult things to prove. That's what the prosecution's trying to prove right now. And you look at it, all it takes is one juror to say, I'm not playing this game.
And how does that differentiate from the John Edwards, also a North Carolinian?
I never thought about that. That's actually a very interesting question. I haven't seen anything written about it. I never even thought about it. But wow, it's by the way, it's the same news publication.
We got 2 law interns here. They can look.
Yeah, there you go. But when you think about it, right, from an investment perspective, my clients who are bottom up stock pickers have never had to really put this into their equation.
Yeah, right.
And it becomes really hard, particularly when you see if you own a stock that has Mexican cross-border and on the fundamentals, it's great. But these decisions can affect how that company is going to trade.
Sure.
The election is really has more impact on the valuations of assets than any other election we've ever seen. And it's also the election that most people don't want to pay attention to because they don't like candidates, which creates the most opportunity.
It's also an election that 4 years from now, there'll be a totally new president.
New president.
And so the election starts for that.
Yes.
3 days later.
Absolutely. Absolutely. With whoever's vice president is going to be sitting in that driver's seat fighting away at it.
Different topic, but the growing use of earned wage access, where the companies are basically sponsored to get access to payment working versus for their paycheck. Is that
Really? How do I not know about this?
so? There's talk about growing that with making access, like essentially like a payday lender kind of thing on it, but like the companies being involved and giving the employees access to get the payments earlier, like almost like real time on it is. I don't know if you had any thoughts on the concept at all.
It's mind blowing. It's mind blowing to me. So it wouldn't be like a regular pay structure, but rather than me going to a payday lender, I go to my employer, SAP. I'm just thinking about a company here, and I say, hey, I need a loan. So rather than getting a 42% annualized interest rate, maybe I'm getting a 15% annualized interest
I think
rate.
it's even less than that, but it's the company's kind of always like a benefit, like trying to get employees quicker access to the money on it. But at some point you kind of move that forward, there's a impact later on. That becomes more and more prevalent. Well, it has to have some economic impacts.
It would wipe out the payday lenders. Wow. I'm just my brain here is moving. Let me talk to my team about that. I don't know if you need a policy change that would allow the employers to do that, or employers can just do it themselves.
Well, you heard it here first.
I heard it here first.
What, any
I
questions?
learn more from you.
Any questions from board members that are joining us remotely?
Just a comment, Mr. Treasurer, this is Greg Patterson. After hearing that excellent presentation, I'm kind of wishing I was Dexter right now, where the only thing I had to worry about was who was going to feed me and who was going to rub my tummy. But that's just wishful thinking.
Awesome.
Well, thank you for your appearance, and I hope you were going to try to build us up before you left, but so I want to tell you, since you were here last, you may already know this, but thanks to some of the folks in this room, we were able, for the first time in our state's history, to buy debt back at 70 cents on the dollar.
Love it.
I don't know if you've been to any other state that's done that or not.
I haven't seen many states doing that.
So,
Absolutely. Congratulations.
Yeah, it was not a big deal. It's that it never happened before.
Yeah.
DTC didn't know quite what to do with this because it never happened before.
Yep. Right. Right.
So we may have ended up just making a bond payment to ourselves for interest. But anyway, I just that was a combination of Silicon Valley Bank, First Citizens, blowing out that portfolio. There's a bigger combination of where interest rates are in relation to where the debt was issued. I would love to know what the Huntersville debt, that Huntersville debt's probably trading at 68 cents on the dollar right now. I mean, would somebody get that for him later? I mean, I'm just curious. Aren't you curious?
I'm not happy with who's running Huntersville right now, so I don't want to really comment. They're
But
gonna
aren't
raise
you
my taxes
curious to
30%.
know that debt that
Oh, yeah,
you sold
absolutely.
for 100 is now you can
Yeah.
buy back at 64?
Well, think of the Austrian, 50-year, 100-year run, 1%
So,
or whatever
anyway,
it was.
great presentation. I don't know how we're memorializing this, but I had invited the members of the retirement plans to listen into this. I don't know if AM took advantage of that, but I'd love to get that presentation to them. So,
Well, thank you.
Traveling mercies to you. Thank you.
Great stories of debt management. Two great stories today. So hopefully we can get your accomplishments out there and make people known about it. So thank you for having me.
Thank you.
All right. It is.
I'm still here.
No kidding.
Is Dexter there? That's all we care about. Hey,
Sitting right beside me, yes.
let's take a 4-minute break. Yeah, if that's okay with y'all. Say goodbye to our.
Plan on being here.
Yeah, I'm done. I'm done. Got that.
We have to go after Dan, which seems like it's just about every year. That's all right. My name's Troy March. I've got Casey High and Chris Ward with me, and we're going to talk about real estate today. Casey's going to cover approximately the first half of the presentation, and then I'll take it from there. Casey?
Yep, so slide 4, we'll jump in here. This is a snapshot of our real estate allocation. These are percentages of total plan. There we go. Percentages of total plan at the end of Q1. So today we're underweight our 8% strategic target by roughly 130 basis points. 75% of the portfolio is allocated to core. The remaining 25% is non-core. Both the core and the non-core portfolios have dropped in net asset value and as a percentage of total plan. The asset class has been, challenged and public markets have rallied, so that's kind of a double whammy. We made $1.5 billion of commitments in 2022. Most of that went to our non-core strategies, but our managers since then have been patient in drawing down that capital. Until that capital is called, it won't show up in the net asset value, so that's just something to be mindful of. We've seen a slight uptick in buying this year within our 2022 vintage funds, but again, our managers are mostly exercising patience, so we think that'll pay off in the long run. Next slide. This is our investment activity over the past 12 months. See, we've made about $600 million of new commitments across core and non-core. This table really reflects our continued focus to grow our separate accounts. One of the advantages of separate accounts that you've heard us mention before is retaining control over our investments and having the ability to make asset level decisions quickly. So last year we took a look at which separate account assets had loans that were coming due, and we decided it was a good use of capital to pay off the debt on some of those properties and avoid refinancing at higher rates. Earlier in the presentation, the treasurer called out the most recent example of this was in North Rock 4 in Q1. That was a $141 million commitment. This was a 450,000 square foot office campus located in Southern California. And this one was unique because we own a little bit more than half of this property, and our partner is a sovereign wealth fund. And so we were looking at collectively paying off the debt on this, as it was, we were going to have to refinance at higher rates. But what the agreement we came to was North Carolina was going to pay off the whole balance, and that would put us in a preferred equity position in this investment. And our partner, the sovereign wealth fund, agreed to pay us a 7.85% preferred rate, for us paying off that debt. So that's going to accrue to us on an annualized basis as long as we hold this asset or until we refinance. So definitely a good de-risking example and also a return answer.
So that preferred was on their balance or the total?
It's on the total. It's going to be on their balance. On their balance. Yep. Yep.
What, 7.85% what?
Interest rate.
I know. Oh,
Preferred rate.
but this is the loan we took out.
Yep.
Well, we paid off the loan.
We're paying ourselves, they're paying us, we're paying ourselves.
Yeah, it's going back to the partnership.
Okay.
So yes,
But this is not the one where the property's been sold.
this one has not been sold.
Oh, there's another one.
That's a multifamily. Is that the one
Okay,
you're
all
referring
right.
to? Yeah.
Okay, good.
Yeah, that one is in process.
That closed.
Oh, okay, close.
All right, sorry.
Yeah.
My mistake.
Yeah.
Okay.
So the 141 you see on this page, half of that was our debt that we paid off, and the other half was the sovereign wealth company. So they're half of the debt.
Yeah.
So.
Yeah, and that 7.85 reflected a roughly 35 basis point premium to prevailing interest rates where we would have had to refinance at. So
That's quote that we otherwise
that's,
had.
yeah, exactly. CMBS quote. All right. Next slide. So looking at historical cash flows, these blue bars illustrate how active the team was in funding contributions in the years following the GFC all the way out to 2016. And this trend, you can see it reversed from 2017 to 2022 as those post-GFC investments were being harvested and distributions were being made back to the portfolio. Over the last 10 years, since 2014, the portfolio has generated over $4 billion of net cash flow. Last year, contributions exceeded distributions. Our separate account partners were actively acquiring assets at discounted values given the distress in the market. And then, as we just spoke about, we were using capital to pay down debt. So that's largely what those contributions reflect. And then year to date, which isn't on this chart, we've already funded over 200 million of contributions. Again, the majority of that going to our separate accounts and primarily for debt pay down opportunities. Next slide. All right, so here we're looking at the pacing of fund commitments since 2006. These do not include REITs, but you see here again just how much capital was being deployed in the years following the GFC. Annual commitments slowed down considerably from 2017 through 2020, which largely explains kind of the lower funding amounts in 2020 and 21 and 22. Today we have 2.1 billion of total outstanding unfunded commitments, but we expect roughly 2/3 of that to be called, and the rest will likely be held as reserves. Since 2021, we've made 2 billion of commitments, and only 600 million have been called to date. So, the takeaway there is that leaves us with some dry powder at a good time to have it. All right, next slide. All right, so this is comparing our total portfolio's performance versus REITs. We think it's important to show you this against REITs because we view REITs as complementary to an overall diversified real estate portfolio. It's not a proxy for the total real estate universe. But having exposure to REITs gives us, actually more exposure to non-traditional sectors like towers and data centers, healthcare properties, developers, et cetera. Our goal for our total portfolio is to generate excess returns through active management and from earning an illiquidity premium over the long term. REITs rebounded in 2023 after having a volatile 22, while our private portfolio continued its drawdown due to rising interest rates. And then over the trailing 3, 5, 7, and 10-year periods, we've outperformed REITs on an annualized basis, but two things really stand out here. The first is roughly 500 basis points of underperformance on an annualized basis versus REITs over the trailing 15-year period. If you take a closer look at this, it reveals the meaningful impact of dropping off 2008 from that performance period. So we ran the performance going back to 2008, all the way back to kind of the end of Q1 08. And we found that the annualized performance of global REITs drops by roughly 600 basis points just by including those last 3 quarters of 08 and the first quarter of 09. So this 15-year period starts almost exactly at the market trough, and it captures all of the post-GFC recovery for REITs, but it doesn't do so for private real estate. It's appraised values of privately held assets, as you know, are reported on a lag basis. So you're not seeing the benefit of that recovery in this chart. This is one reason why having a liquid real estate sleeve within total real estate portfolio is beneficial. Being able to rebalance between private and public can meaningfully improve performance. The second thing that stands out is the negative 1-year returns for the total portfolio versus REITs. Last year it was just the opposite. REITs were down over 20%, while private real estate was actually slightly positive over that trailing 12-month period. And so really this is just an illustration of the increased volatility we'd expect to see from REITs. They're more correlated with broader equities over the short term, but they behave more like private real estate over the long term. Next slide. All right, looking at performance of our core portfolio. For the 1-year period, we saw a positive selection effect from our strategies in global developed REITs, industrial, and retail. These helped to offset poor performance in office and multifamily. From an allocation effect standpoint, the biggest impact, once again, it comes from our persistent underweight to industrial, which continues to be a detractor to relative performance. Industrial has consistently been a top performing sector over the last 5 years. Interestingly, it now makes up a third of the private core benchmark, and that's double what it was in 2019. So from roughly 17% to 33%, it's increased quite a bit. At the end of Q1, we were roughly 540 basis points underweight industrial versus the benchmark. Okay, next slide. Story's really not that different for non-core real estate. But the biggest difference is the effect of our outsized weighting to legacy closed-end funds. And I'm defining legacy here as 2013 and older vintages. Many of these funds have been extended well beyond their initial terms. Currently, more than 20% of our non-core portfolios in funds of 2013 and older vintages. That's 37 out of 61 active funds that we're calling these kind of tail positions. Some of the assets in these funds are challenged. They require comprehensive 1- and 2-year business plans to work out and bring up to a marketable standard. But managers are also reluctant to let go of performing assets that they feel are not being fairly priced in this environment. Said another way, bid-ask spreads are still really wide, so they just don't want to let go of good assets in this environment. So Unsurprisingly, these funds have had to aggressively write down their remaining assets, and as a result, our short-term, our 1 and 3 year performance has suffered. Near term, we expect continued headwinds for the non-core portfolio, again, due to these tail positions and then the J-curve effect of recent commitments we made will impact the performance. But we do still expect the portfolio to outperform over the long term.
When these managers are extending, are they reducing their fees?
Yes.
In some cases, but not in every case. It just depends. Obviously, that's something we really hammer home to the managers from the very beginning of the funds. Now, I've taken the stance of when we have new funds and I'm at their annual meetings, I ask them, what are you going to do 10 years from now when it's time to extend, and put them on the spot then and there in the hopes they'll remember 10 years later what they said. Because we've seen some of the managers that have cut their fees, but unfortunately not everyone, and it's situational.
Probably better to have it in writing.
Yeah. Well, I mean, what we do have in writing is the contract, the limited partnership agreement, which says that they don't have to. And you're not going to be able to negotiate that in. It's just simply not market that they would put that in the contract in the beginning. And perhaps rightfully so, because you don't want to put a manager, if they don't have a whole lot of funds, like if they're not a Blackstone with 20 different funds where they have lots of different revenue sources. Blackstone's an example of a fund that will cut their management fees because they've got a lot of revenue coming in from other places. But the managers that don't cut their fees, and if you did, it would be a problem, are the ones that don't have a whole lot of other funds. And so if you completely cut them off, then you're cutting yourself off because they don't have they don't have the money to keep the staff to manage your assets. Does that make sense?
Also, if they're out of the money, they may just be incentivized to fire sale these assets and move on to the next fund.
Right, yes. So anyway, I'm going to take it over from here. The numbers don't look great. Very different even from last year when our total 10-year return was 9.2% last year. There's definitely no hiding the fact that real estate has had a rough 2-year span. Overall, this has been driven primarily by the rapid rise in real estate and interest rates, That plus the work from home trend created a perfect storm for the office sector. We feel that valuations are bottoming and that a strong rebound will take place in the next couple of years. I was at the Blackstone annual meeting last week, and after 2 years of being very cautious, Blackstone believes valuations have bottomed and they're now on the offensive. They've made several large acquisitions this year, and they're in the hunt for more, for sure. Industrial, data centers, and residential are their highest conviction themes. On this page, regarding our diversification for total real estate, changes from last year. Office is down 240 basis points. Residential is down 350 basis points. Industrial is up 280 basis points. Retail is down 50 basis points from last year, and the other category is up 260 basis points. Obviously, it would have been better to have had less office over the last few years, but the office that we do have in our separate accounts, which represents about 50% of our total office exposure, is generally considered long-term hold assets that we hold for cash flow reasons. As for industrial, we continue to be materially underweight our target. I would like for the industrial portfolio to be in the 30 to 35% range, not because that's where the benchmark currently resides, but because I think that was the appropriate range for a well-diversified portfolio and my current level of conviction for that major asset class. For what it's worth, and I believe his opinion is worth a lot, John Gray of Blackstone last week said, quote, "The decision to invest in industrial is an easy one." And I would agree with that sentiment. The continued growth of e-commerce and other tailwinds will make industrial a good bet for several years to come. Over the next few years, I would expect our exposure to industrial and retail will grow, as well as the other category due to our self-storage separate account that falls within that other category. That growth will come at the expense of office and residential sectors. Primarily, the office sectors over the next few years. Slide. Over the last 5 years, our industrial position has grown primarily at the expense of office exposure. The drop in office has in part been due to asset sales, but more of it has come from the devaluation of the assets due to the work from home issues. Furthermore, our industrial separate account has performed very well for us. We originated it in 2016, and the inception to date returns for it are twice as high as any other core investment we made. Slide. We introduced this slide last year to highlight the growth of our separate account program. That growth continues, and we will discuss that even more this year. Slide. This pie chart shows our allocation mix for all real estate, core, non-core, and REITs combined. The bar chart on the right introduces a new term that we call higher control structures. We have a couple investments, which we'll detail on the next page, that are not separate accounts, but are structures that, like our separate accounts, we have significant investment in and a higher degree of control or influence. We wanted to show here in this bar chart by sector how much of our portfolio is in these higher control structures, which is quite a bit. Slide. This slide lists our higher control structures. 4.5 billion of our 8.2 billion, or roughly 55%, is represented here. Most of these are separate accounts, but 2 additional investments fall into this category we describe as higher control structures. Rockwood Multifamily Partners is an open-end fund where we currently own about 65% of the fund. This exposure used to be in a separate account, but we used the assets to seed the launch of this open-end fund, and in exchange, we were able to achieve very good economics on a permanent basis. Better diversification and a higher expected total return were other drivers for that decision. The other one here is Edens. This is a platform level investment. Edens is a high quality grocery anchored retail platform. And this is a new slide that we created to show where we have, Casey alluded to earlier, that we have a disproportionate amount of our non-core investments in the liquidation phase, which creates a major drag on the returns. Ideally, this chart should look like a bell curve. Unfortunately, we still have a lot of closed-end fund, commingled funds that are taking too long to wrap up and liquidate the last remaining assets in the fund. Even if this is a fund that otherwise has performed very well, these last assets in the fund are kind of hope note assets that they're hoping will turn around and come back. And when there's a downturn in the markets like there is now, those are the type of assets that get whacked first and whacked the hardest. So because we have such a large amount of them as in numbers, we've really taken it on the chin in our non-core portfolio due to this large amount of tail end positions. This is one of the many reasons we desire to move more towards the separate accounts or higher control structures where we have more control over the exit timing. Slide. This chart represents our views at a very high and average level nationally. Real estate is market specific, but this is kind of an overall average. However, even in the most challenged sectors, we can find opportunity, and even in the most attractive sectors, you can still make bad investments. With that said, data centers and industrial are sectors where we see the best opportunity for growth, which generally leads to good investment outcomes. Office and hotels at the other end of the spectrum are sectors with the most risk to your total return. Virtually all sectors have seen a drastic drop in new development starts, which will lead to improved supply-demand dynamics over the next couple of years. Multifamily, for example, we're seeing peak delivery here in 2024, but also a real trough in new starts. So we would expect 25 and 26 to really see a strong reversal in our favor of the supply and demand dynamics. And obviously, that's market specific. Self-storage has been hampered by a lack of mobility in the home ownership market due to current high interest rates and homeowners that refinanced into ultra low fixed rate mortgages that just simply don't want to move because of that. For sectors that we like long term, any current challenges or weakness simply creates opportunity for us to acquire asset at attractive prices. And that's all I have for today. Any questions?
Any questions for the real estate team?
I have a question. Obviously, you saw an opportunity to take out the debt. Do you think you'll be more partnering as an equity investor or a debt or a lender, kind of going forward with some of this dry powder, with all this money coming due for refinancing?
Well, we like the opportunities as it exists today to take out our own debt. Primarily, we're looking at equity, and I'm not sure if I'm answering your question, but primarily we're looking at making new commitments in the real estate portfolio as equity investments. Ron has been focusing more lately on debt investments, and he has high yield debt in his portfolio, and so he's been looking at more opportunity for real estate specific debt. That opportunity is certainly better now than it's been in recent years when interest rates were as low as they were. Debt funds were a drag on our returns, so we really didn't focus on them. Did I answer your question?
Yeah, I'm just curious what your perception is, because all we hear about is multi-trillions of dollars that are going to be needed to be refinanced.
You hear that a lot, and you heard that a lot back in 08, 09, 10, 11. And the reality is a lot of that just gets kicked down the road, and banks work with their existing borrowers, and that wall just always seems to be next year and the year after, and it never seems to quite materialize. So there's been a lot of money, and another reason why I'm a little more focused on equity investing. There's been a lot of money raised for debt funds, and I believe that money and all that dry powder that's been raised for it's going to create competition for what of that wall actually does come to market. So I'm skeptical that we'll ever see a massive wall actually come and lots of defaults.
I'm going to write that down.
Hope so.
Let's hope so.
Other questions? Does Ron own any debt of anything that you own equity in?
I don't know. Some of the funds that he's in are probably large. I don't think so, to be honest. I don't. I'm not happy.
If you could name and title, identify yourself for the record.
He's been waiting to do this.
It's a high point in my day.
Ron Funberg, Investment Director. No, sir, not on a coordinated fashion.
I know, but
Yeah. In our separate accounts, definitely not. I can say that for sure. In a Blackstone fund where there's 1,000 investments, I wouldn't bet my house on it. But generally, in our separate accounts, we're borrowing from large national banks, not regional banks, not small debt lenders, and not hedge funds or private lenders.
the other meeting I was chairing this morning is the State Banking Commission, and we sat in a meeting with the I don't know what a manager. I guess real estate was there and Ron was there. And this cliff that you're referring to on rolling of all these mortgages typically associated with commercial real estate, office real estate. It was stunning because the graph had money center banks exposure to this cliff, like right here, and regional banks like right here. You remember that chart?
Yes, sir.
That concerns me as the chair of the Banking Commission of regional banks. So I don't know. I think it's real, and I think it's George Soros wrote a book in the 60s called developed this theory of reflexivity that momentum begets momentum, and when somebody starts handing in these keys, then other people are going to start handing in these keys, and things will start to snowball. And so, who knows? But it looks like from the chart that we were shown by that manager that a lot of the exposures in regional banks who are, I can tell you, as the chair of the banking commission, are dealing with very stingy net interest margins. Net interest margins is what funds their profitability and what funds their capital ratios, what funds whether we are in there looking at them or the FDIC's in there looking at them. So it's a very, things are more tenuous, in my opinion, than they seem on the surface.
Inverted yield curve is not the friend of the banks.
So what?
Inverted yield curve is not the friend of the banks.
Right.
I wouldn't disagree. I mean, there's definitely that wall. It's there. We'll see.
And, you know, as we all said, real estate said, I guess through all these rolling crises through my lifetime, silver, crops, real estate, stocks, all the things I've experienced in my lifetime, you know, banks have become accustomed to people turning in the keys. But I think commercial real estate is a little different. Ronald, Troy will tell you about the revolving CapEx wheel. You're constantly having to spend money to keep folks like us in buildings like this. There's 3 people that signed up in our sign-in sheet today, and 14 contractors, because something's wrong with this place. And I know that's not a barometer, but it's kind of interesting. Whether it's the bathroom here or the ceiling there or the air conditioning over there. So I'm not sure. I think banks, unlike in a lot of other things, like they know like the back of their hand, I think they're really reluctant to take these keys back because of the nature of a 70-story building or a 50-story building. I think it's just much different. But something's got to give. You can't take these 2 presentations we just heard and come away feeling like something's got to give. Addiction for money by our federal government. 74% of the population don't want either one of these people to be our president. All these, the cliff, something's got to give. So, anyway. Any questions from real estate from the floor? From the virtual participants?
No,
Yes, sir, that was
just,
very helpful.
I know it's been a hard row to hoe through the last few months, and you guys are doing a great job as always. Thank you.
Is that Mike or Dexter?
Woof.
Touche. All right. With that, we'll now go to our public comment section. Did anybody sign up?
IAC Code of Ethics.
Okay. Is that you?
That's me.
Okay.
Yes, we're going to have IAC Code of Ethics presentation.
Yeah.
All right. This presentation is directed to the IAC members. You are required to review the IAC Code of Ethics annually. Won't review the entire policy. It's been sent to each of you separately. If you have any questions, please feel free to reach out. I will highlight here a few of the key components. There have been no material changes to the policy since the review last year. Some of the more prominent sections. Section 3 restricts transactions between interested parties and the retirement systems. Interested parties means the IAC member himself, the spouse or domestic partner of an IAC member, any partnership in which an IAC member or spouse is general partner or holds 10% or more interest, or any corporation in which an IAC member or spouse owns or controls 10% or more of the outstanding stock. Section 4 requires recusal from IAC voting or from evaluating investment matters when an interested party is involved, or the IAC member is an officer, director, or employee of the involved entity. Section 6 requires confidentiality. Section 8 establishes a duty to proactively identify and promptly disclose to Department Compliance Counsel potential conflicts of interest or code of ethics violations if an IAC member becomes aware of any. And then for any IAC member who has not yet provided their signature to the annual acknowledgement form of reviewing this policy, IMD staff will work with you to get that signed and delivered to us, which we will keep on file. Any questions about the IAC Code of Ethics or about its requirements? Okay, next slide. We'll also take the opportunity to briefly highlight some of the important IMD policies related to ethics. This is a list of key policies which govern the investment management division. These policies are reviewed annually or every other year so that there is a regular, consistent look at these policies to make sure the policy and practice are still in line with each other. One major change to the list of policies in the last year, the placement agent political contribution and connection disclosure policy was extensively revised, including changing the name to the investment transaction disclosure policy. Any questions from the IAC members about any of these policies or anything else in this presentation?
No, thank you.
All right. Well, in that case, I thank you for your time and attention. It's important that we perform this review annually, but also glad to not take up too much of your time. Thank you.
Thank you very much. We'll now go to our public comment section. Did anybody sign up for public comment? Okay. Hearing none, we now deem the public comment section closed. We'll go around the horn to see if any board members would want to add anything before we adjourn. I will tell you in a few minutes, Edward Bowles will be in the building, Harlan's son, which leads me to want to tell you that some of you have heard this story, but back in the day when Harlan Bowles was the treasurer of North Carolina, as a Democrat, he would sit down with the Republican Party state chair every 4 years and admonish them, tell them, challenge them to find the best possible person they could to run to get against him for this seat. And I don't care how old you are in this room, I think you've heard many examples of that type of public servant, where a sitting public office holder goes to the opposing party and says, you need to find the best possible person to run against me because anything can happen in a presidential election. And this job's too damn important to hand it off to just anybody. So I say that to tell you that Ted and I and others, we're going to be setting forth a schedule for the two people who will be on the ballot to be the next treasurer of North Carolina, as far as them being educated about some of the things that are going on here. Obviously, in our November, when is our November meeting?
It's the 20th.
Okay.
21st.
So the next treasurer, the treasurer-elect of North Carolina, will be attending this meeting. But there may be some things done for both candidates equally, treated equally. And I'm trying to keep the candidates out of the business of the people who run these offices. And I'm trying to keep the people who run these offices out of the business of the candidates. It just needs to be separate. So I just want to tell the IAC members that the treasurer-elect will be here in the November meeting, and there may be an opportunity in the next meeting to equally invite both candidates who may want to listen in on these presentations. All right, anybody around the horn? Lentz, Greg, Mike, Dexter?
This is Greg. No, sir, Mr. Treasurer. Thank you for a very informative and productive meeting.
Thank you. John?
Treasurer Lynchborough here, all good. Enjoyed the meeting.
Thanks.
No, I don't have anything to say.
Thank you.
Thank you.
I want to thank staff for making us jump up on the table, and for all you do to keep us in the check delivery business. It's been a particularly hard year to be in the check delivery business, whether it's the 4 officers who were murdered in an ambush in Charlotte, or one of our corrections officers who was murdered in a domestic violence situation in the county just north of here in the last 3 weeks. Our call center normally deals with people who have the blessing of retiring and they're making all these decisions, but people in this building work with those where those delivering those checks isn't quite the blessing that we expect. So with that, I'll entertain a motion to adjourn.
I make the motion, John Anarella.
Greg Patterson, second.
Thank you. Motion second being made. Any further discussion? Hearing none, the clerk will call the roll.
For the roll call, Mr. Brewer? Mr. Coakley? Mr.
Mike
Memmon?
Nevin, here.
And Treasurer.
Yes. Is anybody, before we adjourn, any new staff members that need to be stood up or introduced?
I don't think we have any new this quarter. Yeah.
We have approval.
Oh, you do. I thought you had in the last quarter. Sorry. Go ahead.
Nolan McEwen, public equity, working under Ron as an investment analyst. A pleasure to be here so far, so thank you for having me.
Thank you. Well, you're working for the real boss, so.
That's right.
And we're hereby adjourned. Thank you.